You're live.
Good afternoon. My name is Denise Voss, and on behalf of EFAMA, and in particular, the EFAMA Investor Education Platform, thank you for joining us today. EFAMA is really pleased to support once again the IOSCO World Investor Week, and we look forward to discussing the increased need for financial literacy and investor education, and really importantly, what specific actions are being taken and what can be taken in Europe. So it's really becoming clear in both the public and private sectors that as public pensions will be under growing pressure, European citizens will be increasingly responsible for their own financial well-being. And as a result, financial literacy is considered today to be a fundamental life skill. So our fundamental life skill, which is not something that we've actually thought of financial literacy about in the past. And it's a fundamental life skill because it's essential for society and the economy to have well-informed citizens who are capable of managing their personal finances. So therefore, there's a clear need to improve financial literacy and to broaden efforts to educate investors. And on this occasion, I'm very pleased to present the latest efforts of the Fama Investor Education Platform, a new leaflet aimed at members of the younger generation. It's called Investing for a Better Future, 5 Tips to Do More with Your Savings. It provides tips and guiding principles and aims to help millennials and other citizens to start and continue investing their savings. And we're really also very excited about the potential reach of this leaflet as it's being made available in many European languages. So we'll speak more about that later. After taking you through the leaflet briefly, it will be my pleasure to introduce several presentations and presenters. And this will be followed by a roundtable discussion on the role of the private sector in the evolving needs for the financial education of millennials. We're really pleased also to have some young professionals joining the roundtable to give their reactions and views. So there are a few housekeeping points that I'd like to point out. We'll take questions about the leaflet or the presentations during the roundtable session. Please, though, raise your questions throughout the event in the Q&A section, which you'll find at the bottom right of your screen. It's by clicking the 3 vertical dots and selecting Q&A. So without further ado, I'd like to take you through some highlights of the digital version of the leaflet. I believe you will see that now on your screen. So the leaflet, Investing for a Better Future, 5 Tips to Do More with Your Savings. We just go through to the first, after the cover slide, the next slide. Obviously, we're making a distinction here between saving, putting your money aside, and investing, making your money work harder and grow. We then actually have featured in several parts of the leaflet some specific examples. So I think that this will be hopefully be useful. We tried, obviously, very importantly in the entire leaflet to avoid using jargon and to explain clearly some of the basic important concepts in financial literacy. So this is obviously showing you what happens when your money sits in a bank account today at low interest rates and the impact of inflation. So this is just one example of that we'll see you'll see when you review the leaflet of the common financial literacy principles. We then move on to the slide that actually shows you the tips 1 through 5, setting up a budget, start investing as soon as you can, even small amounts, which is a really important point. Learn how to evaluate risk. Don't put all your eggs in one basket, and just get started. So if we can just briefly go through setting up a budget. We work through the slide that shows the details of tip 1. So focusing on your income, essential spends, non-essential spends, and obviously trying to point this out in an easy way, easy to read way, and obviously a very clear, we hope a very clear way. Moving on then to the next page, we speak about a budget for investment. and focusing on 3 different types of savings. So rainy day savings, goal-oriented savings that you can actually put to work in terms of investing, and then retirement savings. Then moving on, the next tip, start investing as soon as you can, even small amounts. So I think this is the group, the platform discussed that this is actually something that I think a main challenge with all ages, but perhaps more importantly with the younger generation, the thought that in order to invest, you have to have a lot of money already. But it's absolutely not true. Not only is it important to start early because of the value of the power of compound interest, which we'll show you next, but also you can invest small amounts, and it's important to invest, again, starting early. So we can move on to the next slide, which shows why that's important, the power of compound interest. And here it sets out an example of someone investing 10,000 euro over a 10-year period, so 1,000 euro each year. That's Anne. And the fact that she starts at age 25 actually means that at age 65 she ends up with more than David, who actually invests twice as much money, so 1,000 euro over 20 years. But because he starts investing at age 40, he actually ends up with less. So start early is definitely the takeaway here. Then moving on to tip 3, learn how to evaluate risk. We could just go through these slides relatively quickly because I think this is hopefully something that you'll be interested in taking the time to read. Then we move on to tip 4, don't put all your eggs in one basket. So showing and giving an example as well. If we keep going, we see the power of diversification. And I think this is, hopefully you agree, this is a nice, clear example of, again, that power of diversification, diversifying your investments. Then we move to the final tip, which is just get started. I think that was obviously also an important message for us as a platform to ensure we put into the brochure. And then if we move on then to, so we have also, I think a point that's important here is the fact that it's always important to ask questions. And these are an example of some of the questions that investors or people thinking about investing should ask to whoever they end up going to for advice about investing. Then we also, if we move on over to the useful links page, we set out a couple of links about some of these important concepts, financial literacy concepts, inflation, compound interest, and diversification. We also set out, we are in the European Asset Management Association, we also set out putting a link about UCITS, so European investment funds, also about an investment club as a way of investing. And we set out the principles of finance. So if we click on the link Principles of Finance, we'll see actually quite a bit more information that is actually the work and the fruit of one of our speakers today. So please do check that out as well. Okay, so hopefully that gives you a taste to go back and review the leaflet at your leisure. I'd like to introduce now our first speakers who will each spend 10 minutes sharing their thoughts on millennials, money, and investing. So we have two of the 3 speakers are representing the view of the industry, and 1 speaker represents the view of the investors, I should say. The first speaker is Bettina Mazzocchi. Bettina is head of iShares and Wealth for France, Belgium, and Luxembourg at BlackRock. Then we have Massimo Mazzini, Head of Marketing and Business Development at Horizon Asset Management. And last but definitely not least, we have Guillaume Prache, who is Managing Director of Better Finance. So thanks to you all up front for giving us your views and some good food for thought, I'm sure we'll hear. So Bettina, the floor is yours. Thank you.
Thank you very much, Denise. The topic of today's event, so investors' education, financial literacy, particularly among younger people, has recently come to my attention on a very personal basis. Some of you will know that September is really an exciting month for parents because we get to do the parent-teacher conference. and go to our children's school. When I went to my daughter's 9-year-old class, she had prepared this little project introducing herself and her family. When talking about her parents, she said, well, my father is a doctor. My mother, I don't quite know what she does, but she works a lot. So aside from the sobering comment for any working mother, aside from the fact that admittedly she is a few years away from really her investing day, the anecdote is telling because it really illustrates the fact that we don't naturally grow up being financially literate, that finance and managing money is not something of our day-to-day education unless we focus on it. So let me tell you what my daughter couldn't say. I am responsible, as Denise highlighted, for iShares and Wealth, which really means that I am responsible for our distribution efforts in France, Belgium, and Luxembourg at BlackRock. BlackRock, many of you may know, started as a boutique fixed income in 1988. Over the last 30 years, we have expanded our investment platforms, the service and capabilities we provide to our clients, from index investing and ETF to active portfolio management and alternatives, from tailored solution to technology, all this to better support them. Today, BlackRock operates in more than 35 countries and manages assets for clients from all walks of life: pension fund, endowment, foundation, sovereign wealth fund, governments, but also individual investors. BlackRock's purpose is that, quote, we help more and more people experience financial well-being. And as our responsibility evolves in the context of changing economic, social, and geopolitical trend, so must we in order to exceed the need of the people we serve. And this, of course, is at the heart of today's topic. 2020 and 2021 have been significant years in terms of retail investors' behavior. COVID and the lockdown have had a polarizing effect that accelerated a number of existing and underlying trends. One of the key ideas is that we're seeing consumer pulled between, on the one hand, precautionary saving in cash, low asset returns, safe assets, and on the other hand, an increased willingness by a significant number of consumers to invest directly in the markets. So today, what I will discuss are some trends we observed during the pandemic amongst younger generations specifically, and I will also set out some thoughts on what we can do more of around financial education, empowerment, and really supporting the new generation of investors in their journey. So a first big trend we've observed during the pandemic was a huge momentum in first-time investment customers, in first-time investors, really. So one example, in Germany, for example, 2.7 million people started investing into ETF stock or active funds in 2020 for the first time. Most of them opened a brokerage account, and 600,000 of them, so about 25%, a quarter of them, are clients under the age of 35. So this new generation of investors are gravitating toward platforms which offer an easy access to market, extremely low, even sometimes zero transaction fees. Compared to other generations, these young people and professionals are increasingly looking for information through the social media. We know that there is an app for everything, and they feel more confident to make their first foray, their first steps into the world of investing without seeking professional advice. From an industry perspective, it is therefore of the utmost importance that there is a level playing field of investor protection across all channels, whether they are, traditional and established or emerging and disruptive. Digital solutions specifically are very engaging and powerful, but not all are helpful, so we need to pick and choose carefully. it is worrying, without any doubt, that bad advice on social media may influence investors, especially those who are new to the market. Having said that, alongside some influencers and community that might incite short-term speculation, there is also a lot of social media account dedicated to education and making thoughtful financial choices. If we move away from social media into what is available in terms of access and investment solution, interactive solution, with which nudge and encourage new investor to invest optimally for the long term, i.e. by not trying to be smarter than anyone else and trying to time the market, but instead invest little and often rather than risking everything in one go and diversifying the risk, all themes that Denise has alluded to already. These platforms, these solutions can be very powerful and definitely support the novice investors. And we see many players creating useful toolkits and interface to help investors. But sadly, it's not always the case, meaning that new investors do not always pursue a buy and hold strategy. In combination with sometimes a lack of good financial information, this can lead to purchasing securities at top of the market and selling them at the bottom, really by trying to do a coup. If we look at meme stock trends earlier this year, or in other words, stocks that see a sudden and dramatic surge thanks to social media hype, the younger generation of investors were involved perhaps disproportionately in trading these securities. And for some of them, we know it ended disastrously. The same holds for buying and trading cryptocurrencies. Market surveys have found that a significant number of young investors hold crypto assets which don't have the same protection as traditional assets. Overall, though, we see more and more next generation investors becoming confident in investing, and one instrument more traditional that they are increasingly turning to is ETFs. Some young investors are taking control of their financial planning, and they're wanting to invest at low cost with one easy solution, one click that enables them to have a balanced and diversified investment, and ETFs are ideal for that kind of aspiration. Good examples are ETF savings plan in Germany. They are currently the most used first-time investor products with retail clients under the age of 30. That was a bit of a mouthful, but retail clients under the age of 30, the most used first-time investor product are ETF. And we expect this trend to continue in the future. And this trend really is telling, in my view, in two aspects. One, the use of digital platform, and two, the increased appetite for low-cost investing by this generation. I'm now moving on to some of our recommendations on what the public and private sectors could do to support this generation, because we know that financial education is of huge importance for this age group that starts owning its financial future. We strongly believe the finance industry we strongly believe that the financial industry should encourage a series of regular financial health check, aiming to empower customers to develop a lifetime plan to support financial health and resilience. We could think about financial health in the same way as we think about, regular health. It's about maintaining a balance. It's no different when it comes to having short, medium, or long-term goals. While we recognize that financial education remains a national competence, the European Commission can contribute to increasing consumer empowerment with a focus on best practices in the design of these financial health checks and scaling up Europe's digital infrastructure to boost investor resilience and capabilities. This would ensure that every country can offer the citizens access to regular financial health checks throughout their life to set them on the right financial path with actionable recommendation. a framework which encourages young people to regularly review their finance and build up confidence in how finance work for them needs to both the public and financial service to work together. In many member states, the workplace could be an ideal venue for delivering this health check to young professionals, especially if they are supplemented by workplace access to financial advice on the benefits of savings and pension. So a very tangible and actionable outcome to these checks. Now, moving on to the private sector, as of course, we also have a very important role to play in providing investor education. I would cite the example of a partnership we recently established in France with France's leading online bank, Boursorama, to develop and launch a new innovative and low-cost retirement unit-linked solution built with ETF. With that, we also created a larger set of educational material around pension planning and ETFs, educational flyers with videos, clients' webinar, all targeting the French end investors. This enabled the clients to better understand not only the individual building blocks used in their retirement solution, but also educate them on the overall benefit, risks, cost, accessibility of ETF as an investment tool. We're also working with various not-for-profit organizations around Europe to promote financial inclusion through financial education sessions. So one initiative that I very much support, given that, as I mentioned, I'm a mother of two girls, is Invest in Girls. Their mission is to assure the first generation of financially literate girls and increase the number of women working in finance. With lack of women role models in senior financial roles, we see too many girls leaving the industry early on. To help change that, Invest in Girls is creating programs across different countries for girls as young as 15-year-old that provide a comfortable and supportive environment to learn about finance generally. They work with schools, communities, organizations, corporations, foundations, and provide this financial literacy programming, financial literacy programming, where the fundamental of finance are taught on the one hand, but also career paths are explored. So in short, while we can rejoice that more and more people engage in financial planning and investing, we recognize, along with EFAMA, that it is paramount that we collectively need to ensure that the younger generation of investor is provided with the adequate financial education and that we use methods and tools that are relevant for that target group. With that, I will thank you for your time, and I believe hand over to Massimo Mazzini. Thank you.
Thank you, Bettina. I take the floor with the presentation. 1 second. Okay, I hope that you see. Do you see my presentation? Okay, perfect. Okay. Okay. For me, it is with a great pleasure that I participate in this important event, and I thank EFAMA for the invitation. And we think that financial education is a key process to develop in the best way our business and the relation with our clients and new generation clients. Horizon is the asset management company of Intesa Sanpaolo Group that is a leader in the Italian market and with an important international presence. And we managed about €500 billion. So the goal of my presentation is to represent what we do in Italy and abroad about financial education. So to give you a clear representation of our experience. We believe that is need to significantly increase financial knowledge for millennials, and we are very active as an actors in the private sector, the private financial sector in this process. As Horizon, we will provide the training services to our customer with a differentiated approach based on whether they are end customer or distributor. So I think this is a key point. It's not only financial education for final customer, for the end clients, but also for the distributor, that I think that they have a key role in this process. We think that is not currently the financial education a choice, but is a duty. Is part as asset manager, our responsibility to work also with the university, high school, to provide training for students, and is what we are doing. And in Italy, as probably part of the other countries in Europe, is very clear that we need to transform saver to investor. Indeed, I think saver to aware investor, conscious investors, because there are two facts that I want to share with you. In Italy, we have 1,007 billion in deposit, and if we analyze investor under 35 have an equity exposure of 25%, equal to investor over 50. That I think is no sense, is incredible. So it's something that we need to manage in the medium long term. But to enter my presentation very quickly, I talk about 4 points: financial education, savings world and young people, engagement and leadership. Financial education is not only a question how manage money in the best way, but it's also a question of social impact. In fact, there are some social development goals that could be impacted by financial education. And considering that the sustainability is so important and ESG is not only a question of climate, it's also a question of social, we believe that through financial education, we need to improve to reduce the reducing diversified, high quality education, gender equality, and also create decent work and economic growth. That is something that can be impacted through financial education. In Italy, we work with also public actors, the example, Association of the Banks or the Committee for Planning and Coordination of Financial Education, and also with the Italian government that have a specific platform for financial education. What we did and what we are doing, we have a specific platform that is called Everything Wise. It's a complete ecosystem that makes available for the distributor, for institutional customer, but also for financial customer, our experience in the invest money. So our know-how in the investment in the asset management. We perform and we manage these activities online and also through classroom webinar. And the target of our audience is clearly very different. Investment funds, banks, insurance, institutional investor, but also retail investors, student, employee, retirees, and pensioner. The idea is to create a common language in the financial education, contributing to the continuous improvement of our learners in order to reach a sustainable long-term competitive advantages. So this is our experience, and we invest a lot of energy to create this platform for our client, but also for the industry, for the Italian market. The ecosystem is based clearly on digital platform, but also through physical meetings and events. We have, an example, the format of Ask the Expert, the webinar where we discuss about macro scenarios and financial news, training campus for the best performer, or customized courses, certified video lesson for in accordance with the regulator. And also we prepared and we finalized the RG Academy, considering that is an item, is a topic that is very interesting now, but also for the millennial, for the young people. We created a learning object and some documents and some training for final clients, but also for our distributor. Our approach and vision is learning by doing, continuous through financial education, and we use different instruments based on our target. We can use a website, social network, app, and podcast to be sure that our information and our engagement could be effective with the different target. Saving world and the young people. The first point is to understand the young people, what they want, and so I think that the first point is that the major risk for young people is create a process and a relation that can diluting themselves, or don't understand that there is a clear correlation between economic environment and ambient and climate environment. So the consciousness in the economic related to the climate and the green item. And the young people, as I said before, are more careful to the climate problem and issue, and we need to think about this point when we discuss with them. Digital is clearly one instrument that we need to use and to manage it the right way to be connected with them. Engagement. What we are doing, we are working with Assogestioni and the Capitale Umano, and we have different classroom with the university where we introduce what means invest money, what means asset management, and we also try to have an emotive intelligence, so an approach that is customized to each target. The example with a video cartoon or some imaging that is quite simple and immediately comprehensive with the final target. In Italy, we support also one initiative that is the Saving Museum that is based in Turin, and is a new way for learning. This is the gamification. Through game, it's possible to learn finance and the investment concept with a very clarified and simple languages. And is something that we believe for the young people that could be, and we want to leverage for through our presence and our investment. Means video games and apps is something that we use. Leadership. Our steps to enhance financial education. Identify learning needs for each target. So seniority, different countries. Yes, we are based in Italy and we are clearly now focused in financial education in Italy, but we are export our experience also in other countries because we have a presence in 24 countries, mainly in Europe, but also in other Asia countries. Define the content, learning strategies, design and functional features to prioritize the target needs, means the topic, the content, the format. So apply different format and different instruments that we can use. And the final point is the prove the feasibility of the platform by developing proof of concept to validate the capacity to spread education. Means survey or self-assessment and test is another point that we believe relevant to have a circular process in the financial education and enhance the different approach. Bettina has played a very important point, so that we need to think about some alert when we have the target audience or audience of the formative content, the correct learner, and define the specific target. And we need to have a responsibility versus the new generation. And one of the point and the risk point of attention, the risk is clearly that the social channels are more attractive for young people, but we need to manage in the right way these instruments and to be part of the social channel, to be sure that the information that deliver the other player in the social panel are correct, and to compensate with our training, with our information, something that could be wrong through delivered through these social channels, and to be part of the game of the financial influencer. We need to be financial influencer, considering that we have the knowledge and we have the competencies to deliver the right information for the millennial and for the young people, and to try to manage the financial bias and the overconfidence of the investor. I want to conclude and to finalize my message is that we believe that in order to involve millennials, it is necessary to develop the approach according some guidelines. Clearly, the first point is provide the financial education services as described before. Develop a specific engagement model between the asset manager and the millennials, but also between the distributor and the financial advisor. Because I believe that it's not a question of funds or ETF or asset management instruments, but it's a question of advisory. How we can deliver advisor to the clients. And one of the key role is in the hand of the distributor, is in the hand of the banks, is in the hand of the financial advisor. Could be digital, could be physical, but is I think a key point. So as asset manager, we need to work with the end clients, but also with the intermediaries to help them in the engagement of the final clients. To develop digital tools in social media to enhance the most used ecosystem for the young people, for the millennials. Develop services that have the life goals as a model of a relationship. In particular, what we are doing as Eurozone is to create a services, a product that is called goal-based investing. Is a model where the paradigm is what goal you have. You want to invest for car, do you want to invest for home, retirement? And I think is the key point for the financial planning. I think is this point is clearly and well represented in the documents Investing for a Better Future. Is a very clear point, good, very well represented in the documents. I think the first question for millennial is why invest, and not which is your level of risk. When you analyze the profile and you define the profile of our clients, I think the approach is necessary, could be different is necessary to have a different approach versus what we are doing now. That is the first question is, which is your level of risk? I think is wrong. The first question is why you are investing and which are your goals. Then when you implement the strategy of your clients, you can enter in the second question and say, which is your tolerance in terms of risk. But the first question is your goal. Thank you very much for your attention.
Thank you, Massimo. Thank you very much. Guillaume, the floor is yours. Thank you.
Thank you very much, Denise. I hope everyone hears me well. And thanks for EFAMA and for doing this event during the World Investor Week, which is, of course, a great time. And thanks to invite a representative from the individual investors. In fact, I am Managing Director of Better Finance, which is the short name for the European Federation of Investors and Financial Services Users. And so we gather organizations, associations of individual investors throughout Europe. I will, as I'm the third, it's good for me that I will try not to repeat what the two other speakers have said, and also Denise presenting the very good initiative of this EFAMA leaflet on investor education. About financial and investor education in general, it's key to remember two major facts. There is what you can get at school. That is when you are obliged to get education every day, at least every weekdays, and when you are an adult. Unfortunately, when you are at school, there has been, through the last decades, even longer, a massive decline in financial education. I saw an end of 19th century primary school book where you had exercises, primary school, exercises on computing annuities. Today, and I smiled when I heard Bettina with her daughter not exactly knowing what her mother could be doing. I have also a daughter and she has the same issue. She would not be able to describe to her friends what her dad is dealing with. Today, not only they do not learn annuities in primary school, but they don't even learn interest and compound interest, and the importance of which has been underlined by Denise earlier, in secondary school. And of course, they never heard about also stocks and bonds. So now we are dealing with adults. So adult education, it's not compulsory. And let me tell you that they will not voluntarily, on their own initiative, take a lot of lectures, courses, trainings, readings. There is only one case where you get adults back to school. It is when it is mandatory to be able to use the product of the service. If you want to drive a car, you need a driver's license. So you go to car driving, you read the codes, etc. But as you know, you don't need an investor license to look after your financial health. And of course, sorry to say, but investing is not really as fun as driving cars, especially for younger generations. So what do you have left? For improving adult financial literacy today. You have, as you saw, short videos, animated tools, games. In fact, you have the EFAMA leaflet. Let me tell you, you have on Better Finance website 2 educational videos, one on investing in the stock markets and one on investing in investment funds. Which of course I strongly recommend. They are animated videos and trying, like the EFAMA leaflet, to be in plain English language. But this is tricky because you have to summarize a lot, and as you know, the devil's in the details. One other thing is that, and you can see this trend coming up, and it has been mentioned by the 2 previous speakers, try to design for the industry simpler products, and try to address cognitive behavioral biases when designing the products and when designing the marketing of these products. So for example, auto-enrollment in pension schemes, of course, is a good thing, but also would be disclosures to address another behavioral bias, which is called the monetary illusion. And I was very happy to see that this was addressed upfront by the EFAMA leaflet on the negative impact year after year on your savings. So really key disclosures could be a way to educate adults if they are intelligible, if they are not misleading, and if they are comparable. Today, therefore, you will not get adults back to school. So the 2 main places where they can get some financial education is first and by far the point of sale, the retail point of sale, as the industry would call it. And for some privileged ones, because it's still not enough widespread in Europe, is at the workplace. If I start with the point of sale, this is why one reason that it is crucial that if you want that information that is given at the point of sale is truly improving literacy, financial literacy, it has to be bias-free. And we are very happy to see that one of the main goals of the European Commission in the Capital Market Union Action Plan and today in their great initiative, which is called the European Strategy for Retail Investors, one of the main highlighted goals of these initiatives is to ensure bias-free advice. This is really key for adult financial education. Also, if you look at the other point of sale, other point of possible education, which is the workplace, which has been mentioned, in fact, by Bettina as well, it is and corporations that currently offer, for example, corporate savings plans, corporate pension plans, employee shareholder plans. And that is where you can get, and there from the start, normally an independent, bias-free advice. Unfortunately, it's much, much less developed than in the US. For example, in SMEs, it's 100 times less developed than in the US, and we are pushing the European authorities to promote employee share ownership and other savings plans at the place of work. Also, we are very sympathetic to what Bettina said about BlackRock's position on it is about financial health. As I said, you will get these people back to the school bench for listening for hours on investing courses. So it would be good that every 5-10 years or at the critical points of your life, you could get, like for physical health, a subsidized financial health check by independent financial planners, advisors. One last thing I would like to recommend for adult education in general, and then I would like to spend the next 2 minutes for the millennials specifically, is we see often great financial education efforts and initiatives from the financial industry. And we see today the EFAMA leaflet, what Massimo presented on what Horizon is doing in Italy. These are great efforts. But even when they are great, they will be always suspected not to be totally independent, and that there could be some, even if it's not the case, some marketing for their own offerings and services. That is why it is really important and necessary to improve the governance of financial education tools for adults. And the industry needs to involve, in a way or another, independent bodies such as foundations, such as user organizations, in the governance processes of all the very good efforts they do in financial and investor education. For example, in the future, I take this opportunity to make a call that we would be happy to cooperate in the future for a future EFAMA leaflet and cooperate or work together upstream on this kind of tools instead of going separately. As I said, we also did animated tools on investor education. I think that would be much more powerful and trusted by everyone. And in the end, that's what we all want. About millennials, but I see I have very little time left. A lot of things have been said. Millennials, they have specific characteristics. They are not better financially educated than the older generations, at the least, through school. They use another source of information apart from the retail point of sale and the workplace, is the social media. This has been mentioned. They are digitally savvy, and they like to compare offers and execute transactions on their smartphone. They want quick, fast online processes. They don't have too much time to meet and listen to human advisors. They like to look for bargains on their smartphone, so they would rather have simple products and web comparing tools. They also want to control what they are doing. And so the more they feel they control, and I think that's one explanation of the increase in shareholders, young shareholders in the last 2 years. Also, and this has been very well said also by Massimo, they sometimes confuse investing with gambling. And of course, it's meant more fun to play, to make it like a game. And that is why you have a severe competition, I would say, between real investing products, especially long-term one like pension products, and Bitcoin or cryptocurrencies, which for me is a misnomer because they are certainly their main trait is not being a currency. It's being, I would say, a very speculative investment or game. Last thing, they want to be, many young people want to be more engaged, and that could be a solution to the risk of greenwashing if we allow them to engage and to participate as citizens, as individual investors, whether it's through direct investments, like when you have a share. Of course, you should be able very easily, again, also on your smartphone, to exercise your voting rights that go with it, or indirectly. So package to investments like investment funds, pension funds, personal pension should allow better people who are the economic owners to give their view on how their money is used. there are a lot of dangers, and I finish with these characteristics of millennials. And if I can speak one more minute, I will tell you about them. The social media, as you know, they are more targeting emotions than targeting rational analysis and knowledge, and they favor extremely short messages like on Twitter. A danger also when you go digital about asset allocation algorithms. Research from Better Finance on robo-advisors shows that these algorithms give you extremely diverging results for exactly the same profile. Now, we did mystery shopping, and it's quite a horror picture. Impact of costs, I think, needs to be mentioned, needs to be addressed, needs to be explained to people, especially when they invest for the long term, for retirement. 2% of cost more per year, and that is quite often to get pension products with 3% charges annually. You cut your pension in half, basically, and I'm happy to do the math for you if anyone is challenging this. And again, I would like to make a call for to design helpful mandatory keys disclosures. As the experts here know, we are far from it, and they need to be smartphone compatible and scalable with drawdown menus, etc. I think I spoke too much already, so I'll stop there. Thank you.
Thank you so much, Guillaume. Thanks for your wise and practical input as always. And I have to admit, on a personal note, I really like your idea about the suggestion for a future EFAMA leaflet with Better Finance. I think that's a great idea, but to be discussed. So thank you to all of our speakers. I thank you for giving us all of your views and really good food for thought that we'll discuss later on during the roundtable. I realized I'm having technical difficulties, which is why I'm calling in to this meeting. But and I realized I forgot when I introduced the leaflet to thank the members of the Investor Education Platform and to EFAMA as well, in particular Bernard Marin and Daniela, for your fantastic support and a great job on the leaflet. So thank you very much. Now moving on to our keynote speaker, Professor Alex Edmans is Professor of Finance at the London Business School and Managing Editor of the Review of Finance. I recommend you tune into his many fascinating TED Talks. And finally, I also wanted to mention his lecture series on the principles of finance, which started at the end of September, and actually which we showed earlier on when we went through the leaflet. And these go into more detail and go deeper into the principles laid out in the EFAMA leaflet. So without further ado, Professor Edmans, the floor is yours. Thank you.
I'd like to see what invitation I asked me to be now and speak about trying to because the practice of restarting this commitments and a lot of maths and centers. The case for so what it was it's to it's always from the past.
Professor Edmans?
I think it's important to revisit some
Oui. Professor Edmans, the line is very bad. So, sorry, we have difficulties to understand. There is interference in the line, so maybe it's your mic or your. So we haven't understood anything. Yeah.
Can you start?
Check again. No, you're mute. Okay. Okay, so maybe we should try just to get a connection by phone. Because like this, it won't work.
So in the meantime, Bernard, should we ask a few questions to the people, the individuals who've presented?
Yes, I think it's a good idea. Okay, Natalie.
Yes, Denise, I think that's an excellent idea. Whilst we wait for the technical aspects to be resolved, we can already start asking some questions to the presenters, because I've already received some, and I'm sure we will be receiving more. I want to encourage again the audience to submit any questions that they have in the Q&A chat box. So my name is Natalie Westerbarkey. I'm the Director and Head of EU Public Policy at Fidelity International, and I'm the Vice Chair of EFAMA's Investor Education Platform, and honored to be also chairing later the Roundtable. But I actually wanted to ask here, there's a question for Bettina from BlackRock. One participant found her anecdote very interesting, talking about the two daughters, and that we don't grow up being financial literate, and that we need to learn to become financial literate. So the question here is, at what point, Bettina, do you think people should start? And you also highlighted the challenge for especially female young investors. Do they need any specific targeted financial literacy programs?
So first of all, we have to recognize that this is an issue that is not only an industry issue, right? It is set in the broader context of centuries and centuries where really money was handled by the head of the family, who was generally the man. I mean, not so long ago, women couldn't even open a bank account. So it's not going to happen with a snap of a finger. So there is a general cultural evolution of our society that needs to happen and that we need to encourage. I think as individual, we absolutely need to teach our youngster from an early age the concept of risk reward, the concept of saving. You can, save your pocket money and buy, something you really want. The concept of taking risks in potentially earning more, which is more difficult on a day-to-day basis. So I think a lot of the financial education starts at home in our day-to-day basis. I also do think that dedicated programs in schools are crucial and should be much more integrated. I think there are a number of countries in Europe that still don't have any hint of financial education. I think Guillaume very much highlighted this for even secondary school. So that's a second effort that needs to be done. But to answer the second part, so the first part of your question is, this is day to day. This is also needs to be integrated into curriculum. But also the second part is, do we need something specifically for women? And I certainly think we do, in the sense that this is, in addition to the obvious challenges that are shared by both genders, women need to potentially gain need to build a more natural aspiration for the topic, because often there aren't enough role models that can rely on in order to grow. So I do think that initiatives such as the one I've mentioned, like Invest for Girls, which are dedicated for women and girls, are very valuable and contributing to the broader education.
That's great. Thank you, Bettina. I think that's a very clear answer to these questions. I have also another question here from the audience. I think it's directed to Massimo from Horizon, because Massimo covered in his presentation that obviously it's not just about financial education, but also how to manage the money, so the best way. And you alluded to also the social impact, so sustainability, not just in terms of climate, but also social aspects. And the question is here, have you actually seen an increase in interest from sustainable investing by younger generation of investors? So perhaps through your ESG Academy, or are there any data points that would suggest that millennials or young investors get more interested in the sustainability aspect of investing?
Thank you, Natalie, for the question. Yes, I confirm that our experience in Italy, but also in other countries in Europe, show a lot of interest in the young people in sustainable products. Here, there is some answer with the new regulation, with the SFDR, with the fact that you can classify the product Article 8 and Article 9. But in reality, the main problem is to explain to investor what means sustainability and how you apply sustainability in the products. Is the reason why the engagement of the investor on these points need to be more transparent and to speak with the investor about the impact through reporting, to have a language that is the same language of the investor. So which is the impact on the CO2, the impact on water, or impact on on energy, and is something that we are doing, at example, through our green bond impact report. It's something that is very simple and short to the investor to demonstrate which kind of impact you have through 1 million of investments. So it's a different dialogue, it's a different discussion with the investor. And yes, we confirm that there is a lot of interest in this on the sustainable point, sustainable funds and investments, climate, but now also on social. Is the reason why also in Europe, at the European level, there is an increasing issue on social bonds that will be put at work money to manage some social risk, some social impact.
Thank you so much, Massimo. I think that is also a question that we can, so the question on sustainability and does it actually mobilize more of the interests of the younger investors and savers? Can extend that question, I feel, to Guillaume as well from Better Finance, but also to Denise in her role as chairperson of the label agency Lux Flag. So perhaps we start with Guillaume. Do you want to comment on that from your perspective as end investor?
Yeah, with pleasure. In fact, I mentioned very briefly that the millennials, and of course Massimo just confirmed, they are more interested and more, I would say, even more worried about the future of the planet and therefore the future of the mankind who is living on this planet. There is a big issue for us, which is the risk of greenwashing, because it is extremely difficult already for financial distributors to be experts in finance, but they have been trained year after year. But to become experts in environment, in CO2, methane emissions, in social issues, in corporate issues, corporate governance issues, in pollution, etc., I think that is not realistic. And so they have to be helped, but also the younger generations have to be helped. And one key thing we see, and I'd like to give the example of what happened at the Exxon general meeting 2 months ago. Exxon is the biggest oil company. And there we were very happy to see that instead of disengaging and let a big oil company whose investment budget dwarfs the whole Euro Green Deal, they have more free investment capacity than the whole European Union public authorities. If you disengage, then for us it's really dramatic. I mean, it's really counterproductive is a mild understatement. What happened at Exxon is that a small impact investor was able to convince bigger investors, such as BlackRock, by the way, to vote for 3 new independent directors who are and will be focused on accelerating Exxon's transition to energy transition. In Europe, we have a tendency right now to do exactly the contrary. Institutional investors are massively disinvesting, disengaging from oil companies. What do you think will happen? And how will you explain this to millennials, that all these free cash flow capacities that they have, the Shell, the Total, the ENI, etc., because you know the stock market is a zero-sum game. If you Europeans, you disinvest, someone else will buy it and will buy it on the cheap. And they may not have the same focus on sustainability than you have, whether it's, I don't know, Russian, Middle East, Chinese investors, who knows. And end of the day, so the Europeans lose control of this big chunk of the industry, but more worryingly, I think the end result might be exactly the opposite of what people are looking for. In fact, when you see what is happening currently on the prices of gas and oil, I think we should think twice. It's a very difficult, I have no magic solution, but one solution we push for is to allow people, especially the younger generations of investors, to engage. Let's empower them. We have published a lot of research, including this year, on how is the Shareholders' Rights Directive #2 working cross-border within Europe. It is not working. It is a nightmare. It is often extremely costly for an individual investor and also for a small asset management firm, I can tell you, because they told me the same, to really engage. So that's one proposal we made.
Thank you, Guillaume.
Natalie, can I add something, because I think it could be interactive about this point of sustainability, because I think
please go ahead, Massimo.
Is a key point. Guillaume said that the sustainable investment is not a question of 0-1. It's a question of paths. So now, clearly, you can invest in companies that are more sustainable than others, but also you need to help the company that are in the transition mood. So it's a key point that when we speak with the investor and the young people, it's necessary to be very clear on this point. Because on the other hand, there is a catastrophic situation as described by Guillaume. We need to invest in transition and to help the company in the medium long term to move from unsustainable business to sustainable business.
Excellent. I think that's a very good point. And before Professor Edmans joins us at 2:30 again, I wanted to extend the question also to Denise Voss in her role as the chairperson of the Lux flag, because how does it help in terms of financial literacy and guiding the retail investors, especially the young investors?
Thank you, Natalie. Well, I can only agree with what's just been said, and the absolute need to educate on what this is all about, and the fact that this has to be a transition. It can't be anything else. I mean, so at Lux Flag, in fact, we have 5 labels for investment products. 4 of them are impact labels, so aligned with Article 9, looking for sustainable investments, Article 9 of the Sustainable Finance Disclosure Regulation, and one of them is a transition label, and that's our ESG label. So we spend actually a good part of our time ensuring that people understand that difference. The good news is that SFDR is actually quite helpful. So the regulation has actually been quite helpful in that respect, to help have that conversation with who we interact with mainly, which is the asset managers, but also in the public when speaking, in a public venue, if you will. So absolutely primordial, because otherwise it won't happen. And but there's a lot of work to do to make that understanding in a very general, if you will. And I think I was encouraged by the recent strategy document that the EU Commission put out that was just about the transition. I think it was in the context of the EU taxonomy. So that's quite helpful. I did just want to kind of maybe make an interesting comment. Obviously I think ultimately the goal is to make all finance sustainable. So we don't talk about sustainable finance or finance. We talk about just finance being sustainable. And I think one thing I have the opportunity to see close up here in Luxembourg is I have the real pleasure and opportunity to teach at the university and in the Master of Science in Finance and Economics program. And one of the tracks, the specializations they have is on sustainable finance. So they've just graduated it's a 2-year program. They just graduated the first class last year, and there's 25 graduates. This year, there are even more that are going to be graduating. So I think that's really important for the financial industry as well, is to have the talent, the talent of the future, if you will, the younger generation join the industry, and that will also help transform the industry. So. Yeah,
that's a really good point, actually, to help offer courses and certifications for young people to enter into that space also a bit more professionally and support the industry more widely in that transition, offering green products. I have sort of lots of more questions from the audience, and participants are again welcome to submit more on the Q&A box, but there's one theme that comes up in a couple of these questions, which is around gamification, and it has been also mentioned by a couple of speakers. So I believe it's a question for the panel as a whole. So obviously gamification, as Massimo mentioned, is an opportunity to reach more, especially young investors, but it can also be a risk, right? We've seen a couple of incidences in the market where, retail investors obviously went beyond just the investment objective and pursued other goals with online investing. But could that be driven by gamification, and is there a risk in that as well? So maybe I'll start with Bettina from BlackRock to see any reactions.
Sure. So there are 2 steps, right, to becoming a competent financial investor. One, you need to actually care, be interested. And second, you need to learn the skills. So gamification gets you there. So for some younger generation, it just puts it on the map of things that they may be wanting to think about. So fundamentally, it is helpful. Now, the problem is, once you get the customer in, how do you teach them? How do you help them grow their knowledge? And this is where you really have to be discerning, because if you have influencer peddling all sorts of nonsense, then it's super counterproductive. One example that I think Trade Republic has done in France, which was particularly, in my view, illustrative of what we're talking about here, is there was this young influencer who generally is more about tech. And what he said is that I'm going to, for 1 week, download the app and do it for you live and do all sorts of things. And within a week, he invited the head of Trade Republic in France and says, now let's go over the week together and tell me everything I did wrong. And it was very striking, because that guy has a huge audience. He is not a financial expert. The gamification was definitely on, because, every day he was doing something and making trades. But at the end of the day, there was someone who told him, see, this is what you did wrong here. This is where you try to time the market, etc., etc. So gamification in itself, and you can think about other things. I'm sure Massimo will talk about the many initiatives in Italy where you have competition among financial advisors and things like this. So the gamification in itself is a very helpful way to engage people in a topic that may seem a little dry otherwise, but it is absolutely paramount that whoever puts that in place has the right tools, the right intentions, and know what they are doing. Otherwise, the results can be catastrophic.
Thanks so much, Bettina. Massimo, over to you. Do you want to elaborate a bit on the gamification point?
Yeah, but I think it's different to add something to Bettina, because I fully agree on the comment of Bettina, because I think is a very interesting instrument to engage, but is a tool to train some young people. Is if the young people think that invest money is a game, is wrong. So, but it's something that you can use to engage your customer, your young people that are used to use game as a tool. The provider of the game is key because you are not discussing about stock and to trade the stock. You are discussing through game how create your asset allocation, how you can create diversification, how you can manage volatility in the long term, because the risk in the short term is totally different compared the risk in the long term. If you invest in 10 years, it's different to invest in 1 year. So you can represent the goal. You want to buy a car, you need to have 10,000 euro. How you can achieve this money? But clearly the content and the customer experience is key, and the provider is key.
Thank you very much, Massimo. I believe Professor Edmans is not yet joining us again, perhaps on the phone. If the technology fails, he'll try to join us by phone. But in the meantime, I'd extend the question to Guillaume from Better Finance perspective, who represents ultimately the end investors. What do you pick up on gamification?
Do you hear me?
Yes, I can hear you.
Good. Yeah, no, I tend to agree with Bettina and Massimo that it is, of course, first helpful, and that is one reason why so many young people, young adults got a first experience in the stock market, for example, in the last 2 years, since the beginning of the COVID crisis. But two remarks. I think often it's more gambling than gaming, and that is a big danger. So that's the first remark. And when you look at or pure speculation, if you want, again, I think the key competitor to investment products for these people who invest directly in markets is Bitcoin or cryptocurrencies, because it's very easy, very quick to get in, out, sometimes much more easy than to go to a package investment product. I think when I say often, it's
thank you, Guillaume. I'm just getting the message that the keynote speaker, Professor Edmonds, is on the line. Right. So I will try to switch over to him now. Professor, can you hear us?
Yes, can you hear me?
Yes, we can hear you. We can see you as well.
Right, okay. I thought that was the case. So sorry, I dialed back in exactly as you wanted me to earlier, but then nobody was unmuting me. So, but it's good to be here now. So should I go ahead?
Thank you. Yes, please go ahead.
Okay, well, thank you for having me, and I'm sorry about the technical issues earlier. I said, I did try to dial back in, but nobody let me in. But anyway, let's go to the topic of today, and it's a real pleasure to speak on this topic to this audience, because financial literacy is not just something that is a field of research for me, it's something I do care very strongly about. Now, I've been asked to talk about the case for financial literacy. So I'm going to start by talking about, like, why is financial literacy so important, and then what are the tools that we can use. And so why should we care about this? Most of you will already know this, so this slide is not going to be new to many of you, but I think it's useful to highlight many of the points again. So financial literacy is important for everybody. So regardless of your future career, whether you want to go into sciences or finance or art or law, everybody needs to save for their own future and for their family's future. But surprisingly, it is rarely taught. So at school, you don't learn it. You learn maths, English, French, and so forth, but there's no courses in this. Even at university, you don't learn this. Now, maybe if you go to business school, you will learn basic financial skills. But business school, it costs £100,000 to go to London Business School. So ironically, those most in need of financial literacy cannot afford to do basic financial literacy courses. Now, there's a lot of argument for more education. So there's some who are fighting for STEM, science, technology, engineering, and mathematics. And then others who say, well, actually, we have too much in terms of science. Let's have more of the arts. And that could be things from actual art to dance to music and so on. But there's nothing which is arguing for financial literacy. And this is why for decades, this has not been an important part of the school curriculum. And I'm sure all of you will know that there's a huge amount of consequences of poor literacy. So this can lead to a lot of inequality from people in terms of which ways. First, people think about inequality, they look at income inequality, right? The earnings of the wealthy versus the earnings of the less wealthy. But what actually matters is wealth, not just income. What causes inequality is not just how much you earn, but what you do with what you earn. And people can make mistakes because of lack of literacy. One is errors of commission. So it can be that you're taking out, say, payday loans and so forth. You're doing bad things due to being duped by financial complexity. And others are errors of omission. So you're not investing in the stock market, and therefore the great growth of the stock market that we've seen over the past couple of decades, ordinary people are not sharing in this, and therefore we see inequality in both ways. Also, if there are financially illiterate customers, this allows financial institutions to prey on them. For example, what we had in the UK was mis-selling of payment protection insurance, where they offered insurance products that customers did not need or even understand. And therefore, if we have greater illiteracy, then financial institutions, rather than focusing on providing financial services that people truly need, will instead focus on trying to exploit these people. And then this in turn leads to mistrust in business. Well, on the one hand, the greater the illiteracy, the more people will try to exploit this illiteracy, and then the more fearful people will be of the big banks, and this leads to the polarization that we see today. And it's not surprising that a lot of people are wanting to end capitalism as we know it, if indeed business is preying on financially illiterate customers. And indeed why you might see the election of populist leaders, why you might see moves towards Brexit and so on, is because financial illiteracy allows people to allows institutions to exploit it. But the important thing to note is that the outlook is not entirely bleak, because actually there's research to show that even a simple amount of education is effective. So let's take payday lending, for example. So this lends to people at very high interest rates. And one might argue, well, this is purely predatory. But on the other hand, you might say, well, that's important because you're lending to people who are relatively likely to default. So you need to offer high interest rates in order to do that. But what's interesting is actually there are some payday lenders who are willing to try to make sure that they are lending in a fair manner, not a predatory manner. And what this payday lender did was it did an experiment where it put on the envelopes where you get your money how much the interest rate is compared to other sources. And so, well, what they put on the envelope was that their loans were 443%, whereas in other sources of lending, it's much less than that. And that led to a significant decline in the amount of lending that they were doing. Also, another treatment, what they did is they put in the envelope how much is the interest cost of borrowing from the payday lender versus a credit card. And this also had a significant negative effect on the amount that people were borrowing. So one might think, well, financial literacy, we can't do anything about it. And the people who are borrowing from payday lenders will still keep borrowing because they really just need the money or they have self-control issues. This is not the case. Simple interventions can have a large impact. So one thing that I'm trying to do, and this is not the only way to improve literacy, but this is just one example, and I really appreciate you having shared this earlier, is one of my positions outside of London Business School is with Gresham College. And that is an unusual institution in the UK. It doesn't offer degrees. The only thing it does is give free lectures to the public, a bit like Michael Faraday used to give on science. And so my current lecture series is called The Principles of Finance. It's to give very basic lectures on financial literacy to a general audience, so no maths or finance background is needed. And there's the lectures themselves, they're all on the website. And there might be some people who don't learn so well from listening to lectures. So I have a huge set of notes, for example, on the website here. Right, if you go to PDF transcript, which is on the right, then you're going to be able to find some notes, and an example of the notes is here. So this will just go through what compound interest is in a very simple way. And for those of you who don't like watching talks, maybe you can only listen to them. There is an audio file, so here there's different ways of absorbing that. And so I hope that might be useful to some of you or some of the people that you know. Now, what about the current state of financial education? So this is something that I want to speak more broadly than just teaching people basic financial literacy, is I think we need to teach people about finance as a force for good. Because often when people go to business school and they have a financial education, it's how can we maximize profits and make as much money as possible at the expense of society. So the most famous finance textbook is a book called Principles of Corporate Finance. When I was an undergrad at Oxford, I was given this book. When I started at Morgan Stanley, we were all given this book. And this tells you, well, what are the principles of finance? They are to make as much money as possible. Corporate finance is all about maximizing value. And so what does this lead to? This leads to the following view of the world. Right, the value that a company creates can be given by a pie, and we can split that pie to investors in the form of profits, workers, right, in the form of wages, customers in the form of fair prices, suppliers in the environment, and so on. And we often think that as a business leader, our responsibility is to maximize profits. And if we are to do that, if the pie is fixed, the way we do that is by trying to squeeze as much as possible out of stakeholders. Right, so the way to maximize profits, how we're teaching people how to do finance, is let's try to extract as much as possible out of these people. Just to give you an example of this, let me tell you about a lady called Judith Aberg. So she stepped out of the subway station in New York City and looked forward to a normal day at work. And her offices were on Park Avenue. And so on Fifth Avenue. So they overlook Central Park. Great real estate. Who does she work for? You might think she's part of an investment bank, but in fact she was not. She's the chief of the Division of Infectious Diseases at Mount Sinai Hospital. But that day, August the 25th, 2015, was not a normal day. She was called by the pharmacy of the hospital, and she was told that they tried to order 100 pills of a medicine, and they just could not afford it. And she thought, this is crazy. Our credit limit is $40,000. How can a bottle of 100 pills of this medicine, Daraprim, cost more than $40,000? But what she learned was that the price of one tablet had gone up overnight 56 times, from $13.50 to $750. And so a single bottle costs $75,000. How can that happen? Well, it was a company called Turing Pharmaceuticals who did this. And this was headed by a guy called Martin Shkreli, who some of you might know. He was one of the most unpopular people in the US. His strategy was to buy existing drug companies and then hike the prices 56-fold. And importantly, everything he did was legal. Right? If you offer a product, you can charge whatever you want. And because he was brought up in this way, of thinking that the best way to make profit is to price gouge everybody else. That has been the education that he grew up in, and that's what he put into practice. But there's a different way of running business, which is, yes, we do want to make profits, but rather than extracting the pie, what can we do? Is we can grow the pie. And so what this means is that we actively invest, actively innovate, try to create value for society. And as a byproduct of that, then investors might be able to benefit. So the way that you make profits is not by grabbing a more of a slice of what's already there, but by creating new things. And so you might think, well, is that even possible, right? If you are trying to serve society, for example, being nice to your workers or being nice to customers, maybe that's at the expense of profit. So this is why my main job as a business school professor is to study this, looking at data. So I wanted to look at, are companies that are purposeful, they try to serve society, do those companies actually become more profitable, or are they just fluffy companies that are distracted from the bottom line? So to do this, we need to see how to measure purpose. And you might think, well, can we look at the mission statement of a company? But you can't, because it could be that a company has a great mission statement, but never actually puts into practice. So you might think another thing that we could do is we can look at how much does this company give to charity, or how much does it pay its workers? But there's a couple of problems with that. It could be that you're giving loads of money to charity, but not giving it to the right effective charities. And some of you who are sports fans will know that it's not how much, even if you spend a lot on players, you might not be delivering results. So what I wanted to look at is the output, how much value you actually deliver to your workers or to society, not how much you spend. And why is that important? Well, it's some of the best things that you can do for your employees, like give them meaningful work, skills development, a healthy and enriching workplace. All of those things don't cost money, but they make a huge difference. And so what I wanted to do was to measure how well a company treats its workers. And I did this with a list of the 100 best companies to work for, which is a measure of employee well-being. Now, importantly, this list has been around since 1984. So I have 28 years. I stopped the study in 2011. And importantly, those 28 years, they include the financial crisis. They include September the 11th and the collapse of the internet bubble. And this is really important to show that a purposeful approach to business does well in bad times. It's not just a luxury for good times. So I wanted to look at, are companies on this list, are they actually delivering value for their shareholders? Or are they just fluffy companies that are distracted from the bottom line? Now, one of the challenges is it correlation or is it causation? Is it if you treat your workers well, you will do better in terms of financial performance? Or is it the opposite? Once you are already performing well, then you can start to invest in your employees. So I have to disentangle that. After all that, what do I find in terms of the bottom line? I find that the 100 best companies to work for in America delivered shareholder returns that beat their peers by 2.3 to 3.8% per year over a 28-year period, which is 89 to 184% cumulative. So simply put, companies that treat their workers better do better. And this goes against the way that many people will be running their company. So certainly in the UK, you have companies like BHS and Sports Direct, which try to work their employees as hard as possible, try to find ways to pay them below the minimum wage, but still without flouting the law, under the idea that the way to make as much money as possible is to reduce the slice given to workers. When in fact, what the research suggests is that when you treat your workers well, you are growing the pie, they are becoming more motivated and more productive, and you are becoming more profitable. And so I am now a co-author of that textbook and what from the next edition, and we're changing the basic principles of finance, maximizing shareholder value if you want to be a profitable company that involves considering everything, all the consequences on customers and employees and the environment. That's a different way of actually running business. Okay? And so this is something that I just recently wrote in a book last year called Grow the Pie, How Great Companies Deliver Both Purpose and Profit. So why I wrote this is that I think for far too long, people have thought about purpose as being fluffy. Companies that are just there to make a lot of money and to do that by exploiting everybody else. But there is a different way of being profitable, which is how much value that we can create for wider society. And you might think it sounds like wishful thinking to think that companies can both do good and do well, which is why I want to back it up with a lot of evidence and to show that that's something which is feasible. So I wanted to end early just to make sure there's some more time for additional questions because of the tech issues earlier. But just to highlight, what do I mean by financial literacy? Right, so when I was asked to speak about this, and when I looked through all the great work that EFAMA does, we often think about financial literacy as being about people who are less affluent, how they can make sure that they're not exploited, how they can make sure that they can save their money and invest their money wisely. And absolutely, that is really important. We need to reach those people, teach them the basics, the principles of finance, and that's what I'm trying to do with Gresham College. However, on the flip side, right, financial literacy, I think we still need to provide that to the managers and the executives and the investors. And they might think, well, you don't need this. Like, we know how to make money. And I'll say, yeah, you do, but maybe not in the right way. And actually, I think there should be a reimagining of financial literacy, not just from those who are typically outside of finance, but maybe from those who are within finance. And in fact, not only is the current way of doing finance perhaps not a way that serves society, but in fact, it's bad for their business as well, because if the research suggests that an ethical approach to business and to finance is not only good for society, but it improves your long-term shareholder returns, I think there's a lot of potential in that element of financial literacy as well. Okay, thank you so much again to EFAMA for the opportunity. Thank you for those who stayed despite the tech issues, and let me hand back. And I know that there was an interruption, sorry, to the other people who were having their questions answered midstream. So if you want to just recap that Q&A, then please do go back. Thank you.
Thank you so much, Professor Edmans. It was such an insightful presentation, and the slides that you presented supported your speech so brilliantly. And on behalf of everyone, I apologize very much for the technical challenges at our end. We nevertheless were so honored to have you and really benefited so much from your presentation and your presence here today. So thank you so much again. We do actually have some questions that were submitted by our audience. And one of them is, as a young person new to investing and wanting to do something good and bring purpose, where do I start?
As an investor, so what you can do is you can invest in some particular funds which are ethical funds, and it is quite difficult here because sometimes funds will market themselves as being ethical when they might not actually do this. So what you need to be doing is be careful. You can look at the fund prospectus. So what you might look at are things like the long-term returns that they're generating. You might think that you look at, well, what does that actually mean to be ethical? What are their holdings? So there are some funds which claim to be ethical but holding things like tobacco. So what you need to do is to look at the holdings that they have. So a fund which might have ethical in its name might not actually do something good in terms of long-term performance. So I'm not just saying this because of Natalie, but Fidelity is one of the big leaders in this. So I know I know the former chief investment officer of equities, that these are people who take this really seriously. Fidelity's one provider. I'm an advisor to Royal London. So for 6 years, I've been working on the Responsible Investment Committee. So there are many funds which are trying to invest in a purposeful way.
But thank you so much for that answer. And before I actually hand to the panelists for any reactions to your presentation, I wanted to pick up on a question that came up quite a lot with our audience, which is around gamification. So obviously the gamification is a risk as well as an opportunity. So how do we make sure that we minimize the risk and maximize the opportunities around gamification?
I first have to say, well, this is something that I probably don't have as much expertise as some of the panelists. So one of the problems with the professors is they like to be talking heads and say stuff even on stuff that they don't really fully understand. But my little knowledge of gamification is actually at Royal London. We looked at investing in some tech companies where there's some gamification aspect. And I think whenever there is some like gambling aspect to it, that is a bit dangerous. For example, with some actual games, you can spend some money to get some power up in a video game, and sometimes it could be nothing, sometimes you can get a cloak of invincibility and so on. So whenever there is something which is like a random reward where there's a possibility of some really high outsized return, I think that's something which is dangerous. Now, certainly risk is something that we want to get people familiar with, and risk is something where it shouldn't be seen as a bad thing. But whenever the gamification involves some uncertainty, but that uncertainty is mainly on the downside rather than the possibility of massive upside thing, I think that's important, because when you have this sort of addiction to lottery-like payoffs, then you get people, say, investing in a lot of small stocks and IPOs and Bitcoin and so on, because they focus too much on the upside payoff. What we'd like to make sure is to understand, for people to understand that risk is on the downside. Risk is not a bad thing, right? It's something where whenever you play a game, right, there's a chance of losing, but it's something for people to make sure that they understand and are comfortable with.
Yeah, that's an excellent insight, Professor, because you're absolutely right. One has to learn to manage the risk, starting as a young investor with ideally sort of small amounts in order to learn about the risk. So I will hand, as we have obviously time limitation, I will pick one panelist now, Guillaume Prasch from Better Finance, to see if there's any reactions from Guillaume to your presentation.
I hope you are hearing me. First, I would like to thank very much Alex for this very great presentation. And yes, before this presentation, I said that we had a huge risk with the sustainable finance approaches for individual investors, citizens as individual investors, which is greenwashing. And I think this approach of growing the pie, so not eating on the other stakeholders' part for investors, but just grow the whole pie for everyone. And very great example about the workplace, the companies that are the best for the workplace are also overperforming their pace. I think that is the right approach. And my question to Alex is that, contrary to Alex, we are facing a lot of, let's say, politicians or people trying to influence policy who are asking us, pension savers, where we need at some point pension adequacy, which means we need some decent, and if possible, not possible, we prefer to have positive real returns in the end, on the long term. They are asking us relentlessly, okay, but for green finance, you have to accept a trade-off between long-term pension returns, which are already very endangered, as all our research shows that a lot of people are suffering negative real returns over the long term. You have to make this trade-off. And this, it's difficult for us to fight. We have some evidence that, on the contrary, some green funds are overperforming for the same reasons, I guess, that are in the book of Alex. But I would like to ask Alex, what is his view about this big campaigns that would push pension savers to further trade off on their pension adequacy in the name of greenery? Thank you.
Yeah, I think that's a really important question. And so what I presented is that in some cases, there aren't trade-offs. So in employee well-being, there is not a trade-off between purpose and profit, but there is in green finance. Unfortunately, I wish this was not the case, but there was a paper recently published in a top journal showing that companies that emit more carbon are actually doing better. And the reason for this is actually the policymakers' fault, because there's not a fair carbon tax and a carbon price. So I think for policymakers to push pension funds into this, I think the first thing that they should do is the action themselves, for themselves to put in a fair carbon price, because once there is a fair carbon tax, then the trade-off, I think, will be attenuated, because the companies that are irresponsible and polluting will also be delivering lower shareholder returns. So what we saw in July was, I think, asset owners worth $14 trillion were signing a letter to push for a global carbon tax. And I think the extent to which asset owners and pension funds can push for that will be very powerful. But one thing that I might say back to regulators telling asset owners to do something is to say, yeah, we will do, but you need to set the rules of the game so that you actually try to remove some of these trade-offs. Otherwise, it is awkward, right? We need to make sure that our pensioners are retiring well in terms of their income, but we need to make sure that the planet they're retiring into is not 2 degrees warmer.
Absolutely. And actually, there was one other question. I know we're coming close up to our time, but it's a question that was asked in the audience, and I know that is very close, of course, to all of the EFAMA constituency. The question is, the European Commission, of course, they want to encourage households to invest in capital markets away from deposits. Would you have any recommendations to the Commission how to achieve that, how to mobilize private sector money to go more into capital markets?
I think it just might be for people to understand what capital markets are, because people think, okay, I can understand a deposit, I know what the return is here, it's a given amount of percent, but just to understand, well, what are capital markets? So this could be money market funds, this could be equity funds, to say, well, here are the different options that you have. If you don't believe that actually markets are inefficient, then just have a passive fund. And sometimes these passive funds can be free, like Fidelity, they launched zero fee funds, which gives a lot of access to finance for people. So I think making people understand those products is useful, but I think it starts from school. So just like in school, you will teach some general other skills, more academic skills. So yeah, it's important to learn things like Latin, but it's really important to learn something like finance, because unless you have this early, then you will not be able to perhaps invest in these products later.
Okay, thank you so much, Professor. And before I conclude, I want to remind everyone in the audience that obviously the session has been recorded. It will be made available on the EFAMA website together with the leaflet. And the leaflet that was presented at the beginning by Denise Voss will be translated into more than 10 different languages, so it can be used across Europe and beyond in the world. And I want to remind everyone that EFAMA will have an online event, the Investment Management Forum, on the 18th and 19th of November, to which you're all invited to. It will have a CEO panel. We will have EU Commissioner McGuinness and also the new IOSCO Secretary General Martin Maloney speaking. Please feel free to register on the efama.eu website for that. And with that, please allow me to conclude the session in support of the IOSCO Worldwide Investor Week. I'd like to thank very much our platform chair, Denise Voss, and our excellent guest presenters and keynote speaker, also Professor Edmans. All slides, with your permission, will be also made available on the website. I want to thank the audience for joining and participating with questions. And of course, I want to thank very much the EFAMA team, Maran Capel, and especially, of course, Bernard Delbecq, who has been leading the investor education platform successfully for many years. Thank you so much, everyone. Goodbye.
Bye-bye.
Bye-bye. Thank you.